There is a man in the plumbing aisle of a Home Depot in a suburb outside Columbus, Ohio, holding an $8 bottle of drain cleaner. He is 47 years old, wearing a dark navy fleece jacket he bought on clearance at Dick's Sporting Goods 4 winters ago, standing under fluorescent lights, listening to the beeping of a forklift reversing in the next aisle. He is trying to remember which brand of pipes runs under the sink in one of his coin laundromats. His phone buzzes in his pocket. He glances at the notification. It is the quarterly report from his accountant. His personal net worth has just crossed $650 million. He puts the drain cleaner in the cart and keeps walking. Not because he is trying to project anything, because there is nothing to project. Nobody in that Home Depot has any idea what just landed on his phone. And if they did know, they still would not be able to tell just by looking at him. Which raises a question worth sitting with. What would his life look like if they could tell? What would the walk down the plumbing aisle turn into if the number was visible, even for a second, to the man restocking the shelf next to him? Over the next 26 minutes, we go through the 12-year story of how this specific kind of wealth actually gets built. The boring assets, the invisibility, the friend who asked for $85,000 and got a different answer, and the moment when the $650 million report landed in a plumbing aisle and changed nothing about anything. It started in a hospital break room. The man who now owns 240 vending machines, 17 laundromats, 4 downtown parking lots, 3 billboard leases on major highways, and a commercial cleaning company doing over $1 million a year in revenue, the whole quiet empire, got started because a vending machine in a hospital break room on a Tuesday afternoon in 2014 would not accept his dollar bill. He was visiting his mother after a hip replacement. He was tired, he wanted a coffee, and the machine kept spitting his bill back at him. He noticed the machine had been sitting there since at least his previous visit 6 months earlier, because the same brand of chips he had noticed then were still in the same slot, still expiring in the same month, now 3 weeks past due. He took out his phone. He spent 40 minutes reading about the vending machine industry, return rates, placement contracts, route economics, depreciation schedules, common failure modes. The industry averages surprised him, not in the direction of glamorous, but in the direction of workable, boring, predictable, repeatable. 2 weeks later, he bought his first used vending machine from a retiring operator in a suburb outside Cleveland for $900. He placed it in the lobby of his own dentist's office. Revenue 70-30 in favor of the operator. His dentist thought it was a hobby. His wife thought it was a hobby. He also thought it might be a hobby. First month net after product costs and split payment, $190. $190. Not a lot of money. Not enough to change anything. His salary at the time was over $130,000 a year at an insurance analyst job. His brother-in-law's Christmas bonus that December was 3 times what the machine earned. But the $190 did something to him that no paycheck ever had. It arrived while he was doing nothing. He did not drive to the dentist's office to earn it. He did not sit at a desk to earn it. He did not answer email to earn it. The machine had done the entire work of extracting $190 from the world while he had lived a normal week, gone to work, come home, watched a football game, eaten dinner with his family. That was the proof, not the amount, the mechanism. The idea that a machine could stand in a lobby and generate real dollars while you lived your regular life, and that this arrangement, once you had 10 machines, or 50, or 200, would arithmetically compound into something meaningful. The first month proved the physics. Everything else was scale. The first expansion after vending was coin laundromats. Not the trendy new laundromats with app-based payments and craft beer on tap. The old ones. The ones in working-class neighborhoods, where the owner was in his late 70s, wanted to retire, could not find a family member interested in running it, and would sell the whole operation with equipment and lease for well under book value, if the buyer was willing to keep the doors open. He bought the first laundromat in 2016 for $185,000. The seller had wanted $240,000, but had a wife with Parkinson's and needed the closing to happen in 3 weeks. The equipment was 15 years old and rock solid. The building lease had 8 years left at below market rent. The customer base had not shifted meaningfully in a decade because the neighborhood had not shifted meaningfully in a decade. The washer and dryer cycle produced income on Tuesday and income on Sunday and income on the Wednesday between them, whether the S&P 500 was up 30% or down 30% that year. Clean clothes are a permanent need. Recessions do not affect the frequency with which people run out of clean underwear. The old laundromat in the working-class neighborhood turned out to be one of the most recession-proof assets in the entire economy. He bought his second laundromat 6 months later, and by 2019, he had 11 of them, all purchased from retiring owners at prices well below what a private equity roll-up would have paid. The next expansion was municipal parking lots. This one came from listening. He had been talking with a city planner at a Rotary Club breakfast in 2017, and the planner had mentioned, offhandedly, that 4 small municipal parking lots in the downtown of a mid-sized nearby city were coming up for auction because the city needed to raise capital for a stormwater project. He looked up the auction date. He looked up the location. He drove down the following weekend, walked all 4 lots, counted cars, counted meter readings, counted turnover per hour on a Tuesday morning. The auction was on a rainy Tuesday morning 3 weeks later. Almost nobody came. Serious investors do not show up to municipal parking lot auctions in mid-sized cities because the numbers involved are too small to justify the travel time, and because parking is not glamorous. What is the ideal condition for a serious buyer? A serious seller in a boring category that no one else has taken the time to understand. Rainy municipal auctions on Tuesday mornings fit that description exactly. He bought all 4 lots for a combined $760,000. Within 18 months, the lots had produced enough net cash flow to have paid for themselves twice over, with 60 more years of lease control remaining. Nobody at the Rotary Club breakfast the following year remembered that he owned them. When a friend once asked what he had been up to, he said, "Oh, some real estate stuff. Boring." That was the whole answer. The third expansion was land under roadside billboards. Not the billboards themselves, the land underneath them, leased in perpetuity to advertising companies. This category of asset almost nobody discovers unless they specifically go looking. In 2019, he bought his first 3 parcels, small strips of land, each less than 1/8 of an acre, along the shoulders of state highways in Ohio and Kentucky, each with a working billboard on it. The advertising companies had been leasing the land from the previous owner on 25-year contracts with annual rent escalations tied to inflation. When the previous owner died, his heirs did not want to deal with 3 tiny, weird patches of highway shoulder producing modest recurring checks, so they sold at a discount to the first buyer who understood the assets. That was him. Each billboard parcel now generates between $12,000 and $18,000 a year in nearly passive lease income, and the value of the underlying land has appreciated regardless of anything happening in commercial real estate. The fourth and largest expansion came in 2022, when he bought a commercial cleaning company, the kind that services schools, small hospital clinics, dental offices, and government buildings on multi-year contracts. The company had over $1 million a year in revenue when he bought it. The previous owner, a woman in her early 60s, wanted to retire and travel with her husband before her knees gave out. The company had almost no growth potential in the ambitious startup sense, and no venture capitalist would have looked at it twice. But it had 140 long-term contracts, most of which auto-renewed, and a stable workforce of over 50 part-time cleaners who had been with the company for years. The gross margins were unremarkable. The net cash flow was extremely reliable. He bought it for 4 times normalized annual net cash flow, paid himself no salary from the company for the first 2 years, and reinvested every dollar of profit into paying down the acquisition loan and buying 2 smaller regional cleaning companies that competed in the same category. By the end of 2024, the combined cleaning operation was doing over $3 million a year in revenue. His accountant is a woman named Susan, who has been doing high net worth taxes for 19 years. When she took him on as a client in 2020 and did the first full portfolio review, she paused halfway through, put down her pen and said, "This is the most deliberately uninteresting portfolio I have ever seen in my life." She did not mean it as an insult. She meant it as an observation. Every asset he owned solved a basic, ancient, permanent problem: hunger, laundry, parking, advertising, cleaning. None of them were disruptible by a mobile app. None of them depended on a hot sector or a favorable regulatory environment. None of them required brilliant timing or a unique insight into consumer trends. Each one of them, individually, was so boring that most sophisticated investors would skip past the description entirely. Together, they compounded into a system that produced roughly $25 million a year in net cash flow, at the operating level, before any of the investments in the public equity portion of the portfolio, which was itself a plain index fund allocation with a bond ladder for stability. Thomas Stanley's 1996 book, The Millionaire Next Door, which almost every wealth management advisor has been quietly recommending to clients for 30 years, documented this exact pattern in aggregate. Real millionaires in America, according to Stanley's data, overwhelmingly owned unglamorous businesses, drove used cars, and lived in modest houses their neighbors assumed were owned by middle-class earners. The concept was not new when he stumbled into it in a hospital break room in 2014. It just was not widely practiced. Why isn't it widely practiced if the mechanism is this well documented and this reliable? Because it does not feel like wealth building while you are doing it. It feels like buying a used vending machine from a retiring operator for $900, or driving to a rainy municipal auction on a Tuesday, or sitting at a kitchen table with a laundromat lease and a calculator. It does not look like the version of wealth building that shows up in movies, in social media, or in most business school case studies. And so most people who could do it, and there are millions, never start. Because starting requires walking through a door that has "boring" written above it in large letters. Quick pause. This channel is not for anyone looking for a fast trick. It's for anyone running the 20-year game, the kind of financial system that does not move quickly, but also does not fall apart. Subscribe if that is the game you are actually playing. The next section covers what invisibility actually protects, the specific things that go quiet in your life when nobody knows. He drives a 2013 Toyota 4Runner with 97,000 miles on it and a cracked plastic front bumper he has not bothered to replace because the crack does not affect the vehicle's function. The 4Runner is worth about $11,000 in current market condition. He bought it used in 2017 with cash from a dealership auction for $18,500. He plans to drive it until it stops running, which he estimates at another 60 to 80,000 miles, based on how Toyota engines age. His house is a 4-bedroom colonial in a suburb outside Columbus that he and his wife bought in 2009 for $285,000. They paid it off aggressively over 11 years, and it has been mortgage-free since 2020. Similar houses in the neighborhood now sell for around $420,000. Nothing about the house signals anything unusual. It has a 2-car garage, a mid-sized lawn, standard middle-class landscaping, and a Ring doorbell his wife installed because she liked the notifications. His clothing is largely fleece jackets, jeans, plain t-shirts, and rotating pairs of decent quality but unremarkable sneakers, most purchased on clearance at big-box retailers. He owns 3 suits, one for weddings, one for funerals, and one for the occasional business meeting where he cannot avoid looking like a person who owns businesses. All 3 suits are from department stores, not tailored, and all 3 are more than 5 years old. None of this is a costume. He does not go to elaborate lengths to hide his wealth. He simply does not have any use for the visible signals of wealth. And the invisible signals, the assets themselves, the cash flow, the compounding, are more valuable to him than the visible ones would be. This is the essential thing. Most people building wealth intend at some point to display it. The display is understood as the reward for having done the work. He never developed that instinct. From what I have watched of people in this category, that instinct is either present from the beginning or it is not. And no amount of wealth accumulation converts one type into the other. He is a person who was never going to display it, and the accumulating money simply gave him more of what he already valued: quiet, autonomy, and the absence of unwanted attention. The absence of unwanted attention turns out to be worth an enormous amount of money and freedom once you actually experience the alternative. What does invisibility actually protect against? Consider the alternative. Consider what would happen if his neighbors knew. His college roommate would ask him for $85,000 for the food truck expansion, which is a real request, and we will get to it in a moment. His cousin's ex-husband, who has not been in touch for 11 years, would suddenly remember him and reach out about an incredible opportunity. His high school class, whose reunions he now attends normally, would collectively adjust their behavior around him within 30 seconds of the number becoming public. The barista at the coffee shop where he goes on Thursdays would greet him differently. His pastor would begin dropping subtle hints about the church's building fund. His neighbors would start asking his opinion on renovations they were considering, because the assumption would be that he had opinions on things costing more than his current lifestyle displayed. Every single one of these adjustments would take something from him, because every one of them would require him to spend some fraction of his day performing a role rather than living his life. Now do the same exercise for your own case, if you can bear it. What would change about your Tuesday if the people around you thought you had $650 million? How many conversations would need to be curated? How many opportunities pitched? How many long-lost family members remembered you the following week? The exercise is uncomfortable because the answers are usually specific and immediate. And that specificity, the concrete, immediate cost of visible wealth, is exactly what invisibility protects against. Morgan Housel writes about this in The Psychology of Money. The observation that money's most valuable dividend is control over your own time, and that visible wealth systematically converts time from your own control into time spent managing other people's perceptions of you. The mechanism is not vanity or paranoia, it is arithmetic. Every hour you spend being seen as wealthy is an hour that is not spent doing whatever you would otherwise do. And for a person whose actual preferences were formed before wealth arrived, the otherwise is almost always more valuable than the recognition. So, the invisibility, when you look closely at it, is not modesty, it is not humility. It is a straightforward optimization. Maximum control over one's own time, achieved by maintaining the exact set of visible signals a middle-class analyst would have. Boston College's Center on Wealth and Philanthropy has published research on this exact behavior pattern among high-net-worth families. It is not universal, but it is common enough among self-made wealth in America to constitute a documented category. The category has a name in Stanley's work, The Millionaire Next Door, and the name has stuck for 30 years because the phenomenon is real. The hardest part of the invisibility is not the discount fleece or the cracked bumper. The hardest part is the moment when someone you love asks for help, and the honest answer is complicated. In late 2023, his best friend from college, a man he had known since he was 18, best man at his wedding, godfather to his oldest child, asked him for $85,000 to expand his food truck business into a second truck and a small commissary kitchen. The friend had been running a single truck for 6 years. It made a modest living, but not enough to support the second child his wife was expecting. And the friend had done the math on adding a second truck and thought it would double his income within 18 months. $85,000 is, relative to his portfolio, an amount so small it could be reproduced in about 11 days of passive cash flow. Emotionally, it was trivial. He could have written the check that afternoon without noticing. He did not write the check. What he did instead was sit down at his friend's kitchen table for 4 consecutive Saturdays, going through the friend's actual business, the lease terms, the food costs, the labor costs, the maintenance line items, the insurance, the parking fees, the seasonal variance, the tax situation, the friend's own household finances behind the business, and helping him understand, line by line, that the $85,000 dropped into an operation that had not yet quite figured out its own economics would probably accelerate its failure rather than double its income. The second truck would double the friend's exposure without doubling his understanding of the business. The commissary kitchen had a lease structure that would not survive one bad quarter. The friend's own household finances did not have the margin to absorb the risk of an expansion that failed. Handing him $85,000 would have felt generous. It would also, in most probable scenarios, have destroyed both the business and the friendship within 2 years. What he did over those 4 Saturdays instead was help his friend find state-level small business grants that his friend qualified for and had never heard of, restructure his existing lease to a lower monthly payment in exchange for a longer term the friend was comfortable committing to, identify 3 specific line items, food waste, insurance rate, and 1 supplier contract, that were quietly bleeding thousands of dollars a year, and build a real 90-day cash flow model on a piece of graph paper. The graph paper had come from his friend's kitchen drawer, from a set his kids used for school math homework. The pencil had come from the same drawer. The math was done longhand, without a spreadsheet, because the point of the exercise was for the friend to understand each number, rather than watch a computer produce them. The friend took the model, applied for the grants, negotiated the lease, and by mid-2024 had increased his own single truck operations net income by roughly $17,000 a year, entirely through changes that cost him nothing to implement. He never took the second truck out. 18 months later, when a food truck expansion bubble in his city produced 3 high-profile closures of over-leveraged single-truck operators trying the same expansion path, the friend called him and said, "I would have been in that pile." The friend never learned about the $650 million. The friend still thinks his old college roommate works in insurance analysis and is doing okay. Which raises a question worth naming. Which version of the help was actually more generous? The check that would have accelerated a failure? Or the 4 Saturdays that built the friend's own ability to see the failure coming? Which brings us back to the plumbing aisle of the Home Depot in the suburb outside Columbus in the late spring of 2026, holding the $8 drain cleaner and looking at the notification. The quarterly report has confirmed a net worth of $650 million. The number crossed the threshold during the previous quarter when a small parcel of land under one of his billboards was revalued after a highway expansion project. He looks at the number on the phone for about 4 seconds. It does not feel different from any other quarterly report. He is aware of what the number is. He is aware that this is, technically, an unusual number to see on a phone screen while standing in the plumbing aisle. He is also aware that it does not change anything about which drain cleaner he needs, which laundromat's sink he was thinking about, what he is going to eat for dinner, or what he is doing this weekend. He puts the phone back in his pocket. He looks up at the shelf. He remembers that the laundromat in Springfield uses copper piping under the utility sink, which means he needs the copper-safe version of the drain cleaner, which is $2 more expensive. He puts the $8 bottle back on the shelf. He picks up the $10 bottle. The forklift in the next aisle beeps again. Somewhere near the front of the store, a child is crying. The fluorescent light directly above him is flickering slightly, on the edge of needing replacement. The kind of small, permanent detail that runs through every store like this, that he barely notices anymore, that is part of the constant sensory texture of the actual world he has chosen to keep living in. He continues down the aisle toward the plumbing fittings section, where he needs to pick up 2 new couplings for the same sink. He does not smile. He does not celebrate. He does not text his wife. What he feels in the moment when the $650 million report is confirmed is exactly what he felt when the $190 from the first vending machine arrived in his checking account 12 years earlier. It is the same quiet satisfaction that a well-designed system is producing its expected output. The scale is different. The feeling is identical. That identity, the sameness of the internal signal at every stage of the compounding, is the thing that most people who intend to build wealth for display purposes have never understood and cannot understand until they have actually held the number in their hand and discovered that it does nothing. What produces that feeling is not the number. It is the fact of the well-designed system running as designed. The number is confirmation. The system is the actual thing. 12 years, 240 vending machines, 17 laundromats, 4 downtown parking lots, 3 billboards. 1 commercial cleaning company, $650 million in net worth, a 2013 Toyota 4Runner with a cracked bumper, a 4-bedroom colonial paid off in 2020, a dark navy fleece jacket from Dick's Sporting Goods, a best friend from college who thinks his roommate is doing okay in insurance analysis, a wife who knows the whole story and prefers it exactly as it is. A quarterly report that produces the same quiet satisfaction at 650 million as it did at 190. Two men in a coffee shop, standing next to each other, and none of the other customers can tell which one has the net worth. That is the actual shape of quiet wealth. From what I have watched of the few people who actually build wealth at this scale without displaying it, the 12-year story looks almost exactly like this one. Different assets, different specific numbers, same essential pattern. Boring assets. Invisible signals. A well-designed system running as designed. And whether the 12 years described here look anything like the 12 years ahead of you is being decided, quietly, by what you value about the visible versus the invisible signal, and whether you are running the 20-year game or the game that ends the moment nobody is watching anymore.